Should you refinance your mortgage? Here are 3 signs it's time, real estate experts say. Homeowners who took out a mortgage in recent years as rates hovered around 6 and 7 and even touched 8% are paying attention for opportunities to refinance. Refinance activity rose 2.9% in February compared with last year, Freddie Mac found. However, fewer owners might refinance their loans as they might still be locked in on historically low rates or may see little incentive to do so, the mortgage buyer forecasts. So, Brian, the article states 3 signs it may be smart to refinance. In order, they are: you can cut your rate by 50 basis points or more. You can pay cash for closing costs, and you bought your home with FHA loan. So let's start at the top. You have number 1, you can cut your rate by 50 basis points or more. That's 0.5% for everyone watching. If you can reduce your rate by 0.5%, the article is suggesting that this is a good idea. I like this, especially in the first 24 or 36 months of your ownership.
Yeah. So with this one is, especially right now, if this is a play that you're looking to get into and you probably bought on the high end of the market last year, even if you're going to be staying in the house for, let's say, more than 5 years, there's going to be a cost associated with the refinance, right? And you might have to bring your rate down a little bit more, or, buy the rate down to come down to 50 half basis points. But if you're going to be in the house for over 5 years, it's going to make sense for you to, get that lower payment because you'd be recuperating that investment that you're taking on that lower rate. But now let's say if you're going to be making a move within those 5 years, then you're probably better off just, taking whatever rate or not refinancing if you can make the payment right now and just ride it out until you could just get a full on savings or get rid of the house if you're going to be exiting that investment.
Yeah, that's a good point. And so let's put that in the context for everyone watching who maybe you're wondering if you can refinance and if the market is 0.5% lower than what your current rate is. So let's say, for example, you bought a house in October of 2023 when the rates were at the all-time, well, not their all-time high, when they were at their highest in the last 40 years. If you bought a house in October of 2023, 12 months is coming up soon. So maybe this summer you can start looking at where rates are at. Let's say you got a rate at 7.5%. That means if the market's at 7%, this is something you can consider. I'm not saying you should. It's something that you can consider.
So I have an example. Last year, we actually locked in a client at 8.375.
Woo!
Yeah, 8.375, but this was a special occasion because he did a bank statement loan, but this was exactly what
explain that.
So a bank statement loan is essentially, instead of utilizing your tax returns for, proving your income, what we do is we take 24 or 12 months of your bank statements and then verify deposits that are being able to use to get, qualify your income, and then utilize those so that it allows you to use your real-time income and be able to use as much of it. So we went that route to be able to approve him from a higher amount. It does come at a higher down payment, but he was okay because he was coming in with 20% either way. So the rate was higher, 8.375, but I had mentioned to him, like, hey, this is just a temporary band-aid. It's just a play to get you in because we can't approve you for the amount that you want with your regular taxes to go the regular route. So we're setting him up that I want to say maybe by the end of this month, we're going to be starting his refinance because now rates are below 8.375 and we could take that savings down to maybe a 6.25, maybe 6.5.
Oh, that's a huge swing.
Which would be a huge savings for him because he's at 8.375. So if that's a situation like yours, then you could really still, save that money because whatever way you put it, you're saving almost 2%, right? Well, so even if you're going from a 4 to a 2, you're going from 8 to a 6. It's still a good amount of savings for your payment.
Yeah, proportionally they're way different, but 2% is amazing. I mean, the article even cites that traditionally, if the market is offering you 1% less than what you currently have, like that's like strike, strike while the iron's hot. In this case, part of the let's say, not the consensus, but what I'm trying to say, part of the condition is that what you're going to give up by going for 50 basis points, the market might not give it back to you again. So if the market is 0.5% lower, don't roll the dice and hope for it to go more if the Fed's not moving. If the Fed is moving, marching rates down, then sure, hold your breath for a couple more months and then lower rates will still come. But if the Fed has to hold, then if it's 0.5% lower, then take it.
And that's where I feel that headlines now, like more than ever, if they haven't shown you that they're not going to be 100% true, you need to be very active in the information that you're following, because if you see now, like, you can't just go into it blindly expecting that you're going to have a low rate regardless of what it is. Like, now every little last number in detail could make or break your deal, so you have to be ultra sensitive to the information you're taking and who you're taking it from, because that could dictate a lot of the process and, the success of your transaction.
And so right now we're talking to people who bought their house maybe in 2021 or 2022. Now, I know that in 2021, 2022, rates were still lower. I get that. But in cases where, like Brian's talking about, you had 20% down, you did bank statement loan. So again, with the bank statement loan, there is a higher interest rate because the risk to the lender is higher.
Yes.
Because there is, I'm not going to say unverified income, but it's not the type of income that they deem.
I would say like traditional income that you could verify.
I was trying to think of the word. Traditional source of income, like
yeah.
W-2s and pay stubs and salary, that kind of thing. So that is why the interest rate is higher. But even if you had 8% or 7.5%, and now it's 7.25%, 7% or 6.75%, you're in the money, if you will. As long as you bought your house in the last 24, 36 months, I think it's worth considering. Item number 2 from this article is you can pay cash for closing costs. Now, there are closing costs associated with a loan if you have to redo your loan or do a refinance. But what I was going to say here is also typically what's happening is you are like skipping a mortgage payment. You're not really skipping a mortgage payment because anyways, in your closing costs are going to be your interest and your
prepaid interest and
all that stuff. But my point is, let's say you're paying $3,500 a month for your mortgage and you're refinancing your home and your closing costs are $3,500 to close your loan. Well, if you are not making your mortgage payment in the month that you are doing your loan, then you've basically paid your mortgage by saving $3,500 to go towards your closing costs, thus making it so that your new closing costs aren't rolled into your new loan amount.
Yeah. And I thought this was an interesting play because usually a lot of people are now used to just rolling it into their into the refinance and calling it a day. But right now with everything being so elevated, this might be a better solution because then you could still take the full-on savings without having to tack in more into your loan.
Yes.
And additionally leverage perhaps a lower term because you're not putting in more into that.
It could be a
lower term at what you started paying at. So if you already paid it 5 years in, refinance it at 25 years, and then you could pay your closing costs, and you'll see the difference and with not adding more money into your loan.
And the other thing too is remember that if you are paying your own closing costs out of pocket, as we say, then your balance is essentially the same. Yeah. So if you owe $400,000 today and you refinance but pay your closing costs out of pocket, you can still do a loan for $400,000 and still have that same loan balance with a lower monthly payment. But because the interest rate is lower, you actually will pay off sooner than the original origination date of maturity from your prior loan.
So, for example, here in San Diego, if you're looking to do a refinance, you're probably going to cost you anywhere between maybe $10,000 to $12,000. Prepaid, escrow, loan costs, basically the whole thing, right? So you have the option of putting that into the loan, but if you're able to slash that, then that's a savings right there that you're taking up front without having to tack it into your loan. Yeah. And I think that's actually a really good plan because no one ever really does it. It's just like, hey, put it into your loan. It's okay. You don't have to pay anything out of pocket. But right now, what I'm noticing is that if you're able to pay it up front, the savings is going to be a lot better, and it will make sense for you to be able to get that savings if you want.
I think that's the difference between what sells a loan versus what is smart in the loan. And I'm not saying that it's unsmart to do that. It might be the only way you can if you don't have the money. But my point is sometimes people are just sold the loan that way. Oh, hey, I'll do your refinance. No cost out of pocket. No problem. Easy, right? Keep it clean. And that's fine. But if that's not what's best for the buyer, or not buyer, if that's not what's best for the homeowner and the borrower, then you still have to suggest and let them know, here's this other alternative. You can pay part of your closing costs, all your closing costs, and do whatever is best in the overall picture of what they're trying to achieve. That's more of a mortgage plan approach rather than just sell the loan and whatever.
And that's what I feel right now the climate calls for. It's more of a personalized mortgage plan for you than rather than like, let's just roll the dice. Let me get into something. Doesn't matter what the price is. The rate's so low that I'll worry about it later. Well, right now, everything kind of really matters.
Yeah. And also with paying your own closing costs, this is the same for FHA loans and VA loans. If you can, if you're allowed to, and if you can afford to, then you can still pay them. If you're doing an FHA Streamline or a VA IRRRL, you can do that as well.
And I encourage you, if you are on the fence of running some numbers and noting wanting to refinance, take cash out, or just to see what it looks like, definitely get that done because it's going to give you a lot of clarity. Don't, go to your trusted loan officer and get that information because it could benefit you. Believe me or not, even if you're paying 7% on your mortgage and you're still paying a 17% on your credit card, maybe another like 10% on your car, like you're paying a higher interest rate and other things that you might seem like they're lower, but in the end you're paying a lot more. So definitely take a look into that.
Yeah, that's definitely more of an advanced strategy, but definitely necessary, and also one that we're doing here at the office. I know you've talked to a number of people where it is that high car balance and that high car payment and that high car interest rate, that high credit card rate, and high balance. So the third thing in this article is you bought your home with FHA FHA loan, and I add here or VA. So if you buy your home with FHA or VA, this kind of dovetails to my point a minute ago about the Streamline and the IRRRL. The FHA Streamline and the VA IRRRL are both options for you. Now, you can either go from your FHA to a new FHA, your VA to VA, or you can go from your FHA VA into a conventional loan. Now, in the case of people who have an FHA loan, and it's not just, is the rate 0.5% better? It's, well, maybe there's enough equity in my house that I can refinance out of my FHA into a conventional loan because I'm at the 80% LTV. I have 20% equity now.
Yes.
Maybe I only had 5% down or 10% down when I used my FHA 2 or 3 years ago. Well, guess what? Where are property values? They're higher. They're elevated. So if you have 20% of your equity right now and you want to get out of your FHA loan and you can get into a conventional loan without the mortgage insurance premium, you might actually be saving money.
Because, I mean, think about it. Right off the bat, on average, you're going to be paying on average, maybe anywhere from $200 to $400, depending on your...
A month,
on top of your mortgage payments, just in mortgage insurance. Then you're still paying that higher rate. So sometimes it's a double savings. You get a lower rate and you wipe off $200 to $400 off your monthly payment. So that could make or break somebody.
And this goes back to, kind of the previous point, another previous point where it's like, if you can save that money cumulative and you've done that in the first 24 or 36 months of your ownership, you're still going to end up winning in the end because you'll either be paying off your loan, sooner, if you will, or with less interest.
Yes.
So, or less total interest paid and less out of pocket paid. So if you can get into conventional, great. If you can just do this, the FHA Streamline, or the VA IRRRL, which is short for the VA Interest Rate Reduction Refinance Loan.
Let's go.
I feel like that's redundant. I don't know if they need to say refinance, but okay. Anyways, the IRRRL, then those are two options that you can do a refinance as long as the market is favorable. Specifically with the VA IRRRL, your payment must go down by 5% or more. Otherwise, the VA will not endorse the loan and it cannot be offered to you.
Yeah. With the VA, same thing. It's the great thing about the VA is that we don't need your income. We just need to verify that you're still working. We simply take your rate down and basically help you get some savings. So it's pretty streamlined if you ask me.
Yep. So I think a couple of good options there for this. For those of you looking to refinance, it sounds crazy. It's like, why the heck would you refinance in this market? Well, some people bought in the fall of 2023 or the summer of 2023.
We had a client, we refinanced from a 7.625 to a 6.375 last year.
Wow.
And it's a VA IRRRL.
Oh, yeah.
Yeah. It's
I
I
remember that one. The 1.5% difference.
Yeah. I mean, this guy was
crazy.
Jesus.
Yeah, that's a lot of money every month to save, especially here in San Diego, these loan balances.
That was, oh my God.